Hello, my name is Steve Bigelow with the Candlestick Forum. This week was a very good illustration of why candlestick analysis is very strong as far as allowing investors or keeping investors from getting whipsawed in and out of market conditions. We saw on Thursday a huge bullish engulfing signal. Actually, a left-right combo, a doji followed by a bullish engulfing signal, and a close above the T-line. So what did we need to see to confirm a bullish reversal signal? Bullish confirmation. Well, we can see where the Dow came right up to the 34 EMA. That's why that indicator works effectively. At the same level it topped out a couple of weeks ago, but closed back at the low end of the trading range, right at the T-line. Now, it's still above the T-line. Would that tell us there's still a possibility of the trend going up? Well, that's why the visual aspects of candlesticks can be used so quickly. It takes you only a matter of seconds to analyze. This one was not heading up yet. Maybe they're coming back down and you're in a sideways channel. What would kind of enhance that analysis? The fact that the NASDAQ opened positive after that left-right combo, but didn't close above the T-line, and then closed back below the T-line. Two elements here. One, it closed back below the T-line. And remember, our T-line rule basically says if you do not see a candlestick buy signal and a close above the T-line, you're still in a downward trend. Number one. Number two, look where it closed. It closed below the halfway point of this candle that told us the bulls might be taking control. The Japanese rice traders logic says if that's the bullish candle that tells you the bulls are taking control and they can close it back below the halfway point of that candle, the bears are still in control. We still have to assume we're in a downtrend based upon the NASDAQ, the S&P 500, and the transportation index, all illustrating high probability expectations that as long as the indexes are closing below the T-line, we're still in a downtrend. So that allows us to look at which sectors are acting the strongest. The shipping sector, the agricultural inputs, you want to go short. The specialty retailers, you want to go short. So we recommended Sting last week because of the kind of the fry pan bottom, the breakout, still trading long. Take a look at some of the other shipping, Tank, Fro, and DHT. On the bearish side, IPI is a good indication that when they came right up to the 50-day moving average, a bearish engulfing, continuing this downtrend. Some more to take a look at that have bearish signals at relevant levels. Also, the specialty retail. Carvana has never been able to get back up above the T-line. Wayfair has never been able to get back up above the T-line. Amazon, still trading below the T-line. These all provide high probability expectations that our downtrend is in progress in those sectors. Now, that doesn't mean every single stock is heading down. You can see the fry pan bottom in NERV. A lot of people in our chat room working on this one. And why is this relevant? Because when the market's been heading down, the investor sentiment buildup can be illustrated by the fact that that fry pan bottom is going to be less affected by a downtrend based upon something happening in that individual stock where the bulls are stepping in spite of the market heading down. So when we can witness high probability reversal areas, we were short ALT until we got to a doji, left-right combo right on the 200-day moving average. Why is this important? Because those are buy signals at levels that everybody is watching, which means that is where they're buying. When would you buy this one? Well, if it opened positive and traded positive, we would have a bullish doji sandwich telling us the downtrend is over, maybe now an upside move, and it was all predicated by seeing that the buying was coming in here at the 200-day moving average. That same scenario, if we can assume the market is in a downtrend, and we can see that same information where we're seeing bearish signals right at a resistance level, the 50-day moving average, confirming that's a much higher probability that we're heading for wave 3 to the downside. Anytime we can add an analysis of which direction is the market overall moving, we got bearish candlestick signals, there's your bearish best friend. A bearish candlestick pattern, there's your bearish J-hook pattern. The probabilities are pretty strong. You're heading lower. So with that information, join us October 29th for a full day training on candlestick analysis. We're using the candlestick logic of what option strategies would you have at specific levels of a market trend. You might not be, or you're doing a different option strategy here than you would be here, or here, or here, based upon the probabilities of the direction of a trend and where that trend is. So when you're looking at something like this, maybe this is where we have our put strategies. Maybe here is where we have a put spread strategy. And maybe here we have a credit spread strategy. So this is all just common logic. Knowing what option strategies to use at the appropriate time and fitting in the mantra of candlestick analysis, we keep it as simple as possible. It's not like you're having to learn a whole plethora of option strategies. It's usually puts, calls, put spreads, call spreads, and a combination thereof. So join us Saturday the 29th, starts at 10 a.m. Eastern, scheduled to go to 2, but you'll be lucky if you get out before 4 o'clock. Non-members, $297, and you'll get more than what you expect as far as your money is worth. But here's our tricky marketing concept. Just join for $97, then you can get it for $197, and worst case scenario, at least you get 30 days of using that information and the information provided on the Candlestick Forum chat rooms. That'll be it. We'll see you in the chat rooms.